The equity market scores for first half 2021 are out. And pleasingly, the US market results validate the rotation trade that we had been recommending. For the first half of this year, the worst performers in the US were the beneficiaries of stay home, work from home, the tech and consumer discretionary sectors. The big winners were beneficiaries of a reopening of society and economies, the energy sector, financials, and real estate. This was the rotation trade. For the record, the S&P 500 hit new highs middle of June to lead the major developed markets in gains for first half of the year. The S&P 500 ended the first half year up 15%. The Euro Stoxx 50 was up 13%, and Nikkei 225 was down 1.7% for the first half of this year. Now, looking ahead, developed market stocks can push yet higher on moderately higher inflation, on strong economic and earnings growth. This is the pro-cyclical inflation rally that we had also been writing about. For the second half year, we expect developed market equities to edge yet higher, but the gains will likely be smaller and more selective. Yes, the Delta variant of COVID-19 is spreading rapidly, but stay focused here. The leading vaccines may only be 60 to 70% effective in preventing infections. But at this stage, the science is suggesting 90% effectiveness in preventing severe COVID. So the reopening trade, the rotation trade, that should all continue. We continue to favor financials, industrials, real estate, and the energy sector over tech and consumer discretionary. And what about inflation? Yes, that's real, and it will likely continue to be in the news. But there is still a lot of slack in the labor market. So developed market central banks will likely be very reluctant to raise rates for a long time. Our guess is the first rate hikes in the US will be late 2022. So there's still time for our pro-cyclical inflation trade.